Hello, my name is Luke. I'm going to give you a brief training on the IDA income calculator. This calculator was created to inform the standard practices for determining IDA eligibility. Calculating income can be different for each household and is based on a lot of different factors. When collecting information, remember that it's the applicant's responsibility to provide full and accurate information to the provider. Applicants all sign the certification that you see on the screen. You will ensure that the information is comprehensive and follow up when necessary. In the end, it's the applicant's responsibility to be truthful and your responsibility to collect the information. This will take trust and collaboration, and it can be challenging and time-consuming for both sides. Let's start with a few things to note about the document. Cells highlighted in yellow are places for you to enter data. The first tab is the Instructions and Eligibility Tests tab. Fill out the first 6 questions to start. For household size, use what they report on their IDA application. You do not need to collect extra documentation to verify household size. IDA income and net worth is for the entire household, not just the applicant. And as an asset building program, we have a net worth limit of $20,000, which does exclude the assets and debts of a primary home, 1 vehicle, and $120,000 in retirement savings. The net worth calculation is the second tab. Participants self-report these amounts on the IDA application. It's also not something that we collect extra documentation to verify. Note that all these fields must also be entered into Outcome Tracker. At the bottom of the tab, it will auto-calculate for IDA eligibility. In this example, the full net worth is $180,000, but when the calculation excludes the assets and debts of the home and vehicle plus the retirement limit, the IDA eligible net worth drops to negative $15,000, so they qualify. Now let's move to income eligibility for IDA, where you have 2 options. Either the applicant has been approved for a qualifying benefit in the past 12 months, or you verify that the gross income of the applicant's household is at or below the limits for the county and household size. Step 3 on the first tab of the income calculator is to identify if they are qualifying with a public benefit. If you get documentation from one of the benefits listed, that means they've already been screened for income by another program and they qualify for IDAs. Documentation can't just be a copy of a SNAP card. It should be a benefit letter issued from within the last 12 months on letterhead or other official format listing the applicant's name, date, and benefit they are receiving. If you get documentation for a qualifying benefit, then you are done. No need to do any additional income verification. That's what you save to show they're income eligible for IDAs. You'll select that benefit as well in Outcome Tracker, and you don't need to calculate household income. If not, then you use the IDA income limits. Neighborhood Partnerships updates the income calculator each spring, usually in April, to reflect the current income limits by county and household size. The IDA income calculation is about forecasting the year ahead, not the past year. The IDA income calculation should consider the household's recent income based on the application date. Documentation of income earned after the application date can be considered if that's what's being provided, but should go no further than 1 month after. I won't go into it here, but it's important to read through the last tab on the calculator, which is the Include versus Exclude tab, to get all the details of what counts for IDA eligibility. For example, there are detailed considerations for SSI, cash, full-time students, unemployment, and more. Most income requires documentation. For those that are employed, this should be at least 1 month of pay stubs. When pay stubs aren't available, you might get the details you need from a letter, email, or phone call with the employer. We don't recommend that you collect individual income tax returns unless necessary. And if you are, remember to black out and protect personal identifying information, such as a social security number. At the top of the Consistent Income tab, enter the number of consistent income sources in the household. Add the name of the person and write in the source of income, which could be the name of the employer or could be more generally the source like child support or unemployment benefits. Next, we'll look at the amount and the frequency received. First, if looking at a pay stub, make sure you are finding the gross pay amounts, which is the total before taxes are taken out, not net pay, which is the take-home amount. Each pay stub should have a pay period date range, which will help you identify how frequently they are paid and will help ensure that there are no gaps in pay. You have to decide and then select from the dropdown your frequency received, whether they are paid weekly, bi-weekly, twice a month, or monthly, by looking at the pay period date range. For example, bi-weekly is every 2 weeks, so the pay period is exactly 2 weeks apart on the same day of the week, whereas twice a month is usually 15 days apart on set days of the month every month. Determining the correct frequency can make or break their income total because the frequency received is used to then calculate an annual income estimate. All overtime should be included when present on a pay stub, even when the applicant says they do not receive overtime regularly. If a paycheck with overtime puts them over the income limits, you may decide to include more than 1 month to show income over a greater period of time, but it always must also include the recent month of consistent income. If someone was employed in 2 distinct jobs during the last month, both should be included as separate sources of income. If someone stopped one job and started a new job, you can document only the new income if you're able to verify the anticipated income or salary with the new employer, or you can show total income from the last month for both the old job and the new job, recording it as 2 sources of income and entering $0 for the time periods that no income was earned from that source. In the end, remember that you're trying to calculate what their current consistent monthly income is at the time of application. Now on to self-employment and small business income. Once you have collected the documentation for household members that are self-employed, you can fill this section out. Source of income could be the business name or simply put self-employed. Preferred documentation is a profit and loss statement generated by the applicant. It should show at least 2 months of profit and loss for the business. If you're a micro enterprise provider, you may need to support them with their profit and loss statement before applying. The net profit is then entered into the third field, which could include the profit of the business over that time, or the income that the owner is drawing as shown in the profit and loss statement. Then you put in the number of months that the net profit covers. The form will calculate an average monthly income based on the information you entered. Note that a net loss will not carry over to the main calculation, only a net profit. Here's an example of a tax schedule C, if this is what they give to show their last year's net profit. Taxes are an acceptable source of documentation if it's from the most recent tax year and if it's an accurate representation of their current self-employment profits. Next, I want to explain what to do with marginal income, which is small amounts of income that do not substantially impact IDA eligibility. If an applicant is reporting marginal income, a verbal or written statement is sufficient. Let's look at inconsistent income, which is income that is inconsistent in pay schedule or hours worked, which is where this may be documented. National data tells us that 1 in 5 households experiences income volatility, income fluctuations from month to month. So we should be expecting to navigate inconsistent sources of income as well. To calculate an average monthly income amount, enter the last 4 gross pay amounts from that source of income, and then identify how many whole months are included in the time frame of those last 4 payments. In this example, income was from a side job of house cleaning, which in this situation can be considered marginal income because they wouldn't substantially impact the applicant's household income. They reported 4 amounts that span 2 months, which is then entered here to create a monthly average. Seasonal income is your other tab, which is for income received as a lump sum or income that is not year-round. For example, you'll see that on the include versus exclude tab, students ages 18 to 24 that are dependents in a household only have to report up to $480 of income. For seasonal income, you record the total annual amount from this source. When all sources of income have been recorded, come back to the instructions and eligibility test tab for the total household income at the bottom. You can see here this applicant had $58,000 in total household income. Based on their county and household size, they income qualify for the IDA. If they don't qualify, the bottom box will turn red. They may be able to reapply if their income situation changes or reapply after the income limits for the IDA are updated in the next program year. That's it. Save the income calculator in Excel format. Save the documentation that was collected. We know that this process can be difficult. Situations are all different. If you aren't sure, ask for guidance. If someone increases their income or net worth after they are enrolled, it's okay. They can still stay in the IDA. And thank you all for your partnership in this work.